What's going on, everybody? It's Jeff here. Welcome back to the channel. Market is back at the top of its range. We've been channeling between all the way since late September. In one of the biggest weeks we've seen in quite a while. It seems like that's been the motive for pretty much the entire year. We have quarter three big tech, most of big tech reporting earnings this week, as well as third quarter advanced GDP numbers coming out on Thursday. All of this ahead of midterm elections. Now, there's a couple things I want to talk about. Now, GDP is expected to actually grow, which was opposite for the last two quarters. How the media is going to portray this and what political motive and narrative might spin off of this is going to be a very one to pay a really close attention to, especially when it comes to monitoring how the market reacts. We also have the Federal Reserve that's kind of on the opposite side, really wanting to see a little bit of a slowdown. I'm going to break everything down for you and also take a close look at the charts to prepare you for the coming weeks ahead. So let's get right into it. First off, this white line I have right here has been that level that we've been rejected off of a few times. It's been the top of the range. I've talked about this 356 to 380 for quite some time. You can see we broke through that late on the 21st, bounced up on it, retested it. That's old support becoming new resistance. We came back up sometime in early October, bounced off it again as resistance. And here we are back at the top of the range once again. Okay, bulls are really trying to hang on to this bear market rally, trying to get a little bit of push back up into the 380, potentially 390 before eventually getting exhausted. Volume is a little bit low as of today. Now, when it comes to earnings, you've got Amazon, Google, Apple, Microsoft, okay, reporting all this week. Expect that to shake up the market a little bit, obviously, as they make up pretty much about 1/5 of the entire SPY. All right. So the biggest thing that investors are going to be looking at is that forward revenue, that forward guidance. I talk about it all the time. All right. We watch Tesla beat. We watch Elon Musk come on and really talk about these promising numbers that investors just didn't seem to soak up quite so much, especially because, hey, listen, the economy is slowing down. All right. Now let's talk a little bit about GDP. These are the numbers from the Atlanta Fed GDP. The latest estimate is coming in as a 2.9% growth. All right. Now, between the last two quarters, we had a 0.6% contraction and a 1.6% contraction, which generally speaking would have put the economy into recession because of record low numbers, unemployment numbers, I'm sorry, and a couple other factors. The panel did not classify this as a recession. Now we're expecting to see GDP growing. This is a very detailed article. Washington Post is not really one, media outlet that I look at very closely because it seems like a lot of their articles are very biased. However, this seemed to be very neutral, just spitting a lot of facts. There's a couple of things I want to go over with you first, and then we're going to talk a little bit about the Federal Reserve. So the U.S. economy is expected to have grown robustly in a sharp rebound from the first half of last year. However, economists say that does not reflect the major changes that are happening inside the economy. There are still major concerns about the Fed's tightening that remain. Things are not substantially different. Okay, this is coming from a president of the American Action Forum and former director of the Congressional Budget Office. Okay, now here shows a little bit of a chart of that trend line we were on. Obviously, the recession pulled away from it. We saw that massive growth, okay, over pretty much the entire course of the end of 2020 and the entire year of 2021. Things changed a little bit getting into 2022. A lot of people also said the contraction was from supply chain issues that were catching up. So what these companies were doing, where they were trying to buy as much inventory as they can because they didn't know whether it was going to be delivered, what was going to come in, and that was some of the reasons for why GDP had contracted. All right, at the first two quarters of 2022, that the companies were not buying as much because of the massive inventory they had from the huge orders. Things are going to get a little bit different when we talk about Q3 GDP. So remember, I said that. I'll get to it in just a moment. Article goes into explain a couple other things, talking also about Europe and United Kingdom, which are either already in a recession or almost certainly heading for one. I really look at that as a lot of people are saying that, potentially the US is headed for one, especially in 2023. Okay, I think just Europe and the UK are a little bit closer. Now, China's zero COVID policy has also become a drag on its own economic growth. Now, China actually did report their delayed, GDP, and it does show a bit of a growth. Obviously, if you've seen the news today or taken a look at the Chinese exchange and everything that's happening from the CCP, investors did not feel comfortable about those numbers at all. All right. Economic uncertainty is one of the biggest issues for when it comes to November 8th midterms. Okay. Now, this little excerpt comes from a chief economist and a former Trump White House economic advisor. Obviously, there is political notion when it comes to this, but he states that the economy frequently generates healthy gains in real GDP around the onset of a recession, meaning it'll start to, continue to decline, almost kind of like picture like a declining chart where we get those lower lows, a little bit of that retest, and then a breakthrough. And it actually has happened in the last 4 out of the last 6 downturns. Not great numbers right there. Obviously, it's only 4 out of 6. It's not a 5 out of 6, 6 out of 6, which would indicate a little bit better of a chance. But a growing chorus of economists say a 2023 recession is all but inevitable. The White House pointed to strong jobs growth and steady consumer spending. Okay, now here's where things change a little bit. And this is what I talked about just about a couple moments ago, that growth rates have begun tapering off this year, suggesting that economic gains are slowing. Now, we're seeing a little bit of an inverse. So economic growth had ramped in 2021 due to these companies trying to really fulfill some of that inventory. They slowed down their buying because they had all this inventory. That's why we had a little bit of a downtick in GDP. However, here's where things change. We may see a positive GDP growth this time around, but that's because of a drop in imports rather than higher consumption. So you're seeing consumers starting to consume a little bit less. Therefore, imports are down. Now, imports will actually offset the GDP. Okay, so it's kind of like that false narrative. We're seeing a little bit of economic growth, but the bigger picture is still showing that the economy is slowing. Okay, now there's a couple articles, and you can go through and read all this one, but there's a couple articles I want to highlight. This is going back to July 22, when Snapchat reported had a little bit of an issue, but the title says it all. Jerome Powell wants a slowdown. Okay, this is going all the way back, I believe, until March 17th. The Fed wants to slow down the economy. Okay, so we've seen this narrative of the Fed, trying to raise interest rates to combat inflation. They also want to see a slowing economy as well as rising unemployment. They have not received rising unemployment, which is why when we see these jobless numbers come out and they're actually what would normally be better than expected numbers, the market can turn and take a little bit of a pull, because they know that that's one of the Fed's goals. And that's the same thing that can happen right now with GDP, especially if this number comes out. Now, a lot of this is priced in. Like I said, because it is expected as that 2.9% beat, I wouldn't see a big upset happening. However, you got to play the charts. We are at the top of the range, and it's a very good idea to keep this level on your chart. We break through this, we hold through this. We've got more room to the upside. We bounce off this. Obviously, you know that 356 is your bottom level, okay? Now, last thing I do want to talk about is the expected target rates for the Fed fund rate, which is going to happen on November 2nd. Now, there's a 100% chance, okay, that is at least priced into the market that they are going to raise by 75 basis points, okay? This is just what the market prices in, is what I should say. Sorry, it's not a 100% chance that it's going to happen. This is what the market is pricing in. Now, months ago, I had shown these numbers for December, and the target was about that 375, okay, basis points. And then when you had gone all the way out until that May, June, you used to see that 375, in May, June, you go out to July and you would actually see it, tailing off a little bit. That investors were pricing in that 375 to 4% was going to be the high. The Fed was going to pivot and interest rates were going to start coming down. As you can clearly see, that they had priced that into about December, that it would stick at that 375, to 400 or 4%. Okay, those are the same thing, guys. It would hang around for about February, March, and then it would start to taper going in. And now you're clearly seeing that the market is pricing in a continuance all the way up to 5% as a Fed fund rate. All right. Now, you've got mortgage rates that are leading on this because obviously they're always, forward looking. You've also got some, mortgage professionals that are saying that, listen, rates are going to tail off towards the end of the year. And it kind of does coincide with this a little bit, but the Fed's foot is still on the gas, full throttle. There's been no indication. Okay. And considering we are seeing a little bit of GDP growth, all right, jobless numbers are still low. And obviously, inflation is still really high. I would expect this to continue through. All right. So, guys, that is it for this video. I hope it gives you a little bit of insight when it comes to the GDP numbers, how the market might react. Now, also, one thing I will mention, which I will continue to make videos on this, is depending on what happens, okay, from these midterm elections, because I believe there's only 6 seats, all right, that will really, sway, the House and the Senate. A lot of things can change. Okay. A lot of sectors do very well, especially your green energy, your solar. Obviously, when the Democrats, hold control a little bit more versus when the Republicans hold a little bit more. So I'll continue to make videos on that. It'll give us a good time, especially because we've got at least 2 years, so things can really change. So that's it for this video, guys. I'll see you in the next one.